So, Baba, share them the link. Let them start
Kabiru.
joining. Oh,
Kabiru, are you saying something?
I'm saying something now.
Why can't I hear him now? Is it that this keyboard is faulty? Mara, I just press things. So, Kabiru, you dey hear me? Let me join on my phone too. Maybe I'll be using my phone. I'm coming. Kabiru.
Hello, Alfred. I don't know. Maybe it's from my own end. Share the link to them. Let them start joining first. You understand? Let's see them. So maybe I'll share.
Hello, guys. Good evening.
Good evening, Mr. Alfred. Happy Sunday.
Good evening, everybody. Welcome to today's class. Let me. Okay, our time is spent. I think at this point we already know what challenges I'm having. However, today somebody took my time, so I couldn't schedule the meeting for us. That's why we've taken so much time, and that's why Mr. Yusuf is here. Without wasting our time, we'll just go to the business of the day. I doubt if my objective will be achieved. However, we'll still try to see if we can meet on Wednesday, right? Currency forward. Is that where we were? I think this is futures contract Currency prepaid forward. We looked at prepaid forwards. Where are we? No, we've not looked at prepaid forward. We are still far behind. Or we have not gotten here. I think this is where we are. So the theoretical price.
Can you share your screen?
Theoretical price. Okay. I've not shared my screen yet. Share entire screen. Share. Can you guys see my screen now?
It's coming up. Yes.
Yes, sir.
Can you make it good?
Okay, if you can.
For the benefit of those people that are
From YouTube, yes. So this is my screen. I'm sure we are
is
all
this the new
good.
study?
So this is yes.
Is this the new study pack?
Yes. So I've aligned. Yes. So the yeah, no, it's not the study pack. It's my note, but it's in line with the syllables. It's my note, but it's in line with the syllables.
Okay,
Yeah.
that's fine. Can you try and share again?
Okay, are we together now?
Can you share again?
Can everybody see? Is there anybody that can't see my screen?
Yes.
Is there anybody that can't see my?
Your
Yes,
screen is not
sir.
shareable.
Okay. I will. Oh, Kabiru, he's saying you are not allowed to share your screen. Can you enable me to share screen?
Yeah, try and share now. Let's see.
Okay. I'm trying. No, you are not allowed to share screen. Why?
Oh, yeah, try now. Can you share?
Okay. It's up. I'm trying. If you can see it, let me know. You can see my screen now, right?
Yes, we are continuing.
Yes, sir.
Yes.
Okay.
Please, guys, let's put off our
Okay.
video, right? We don't need a video for this class. Thank you. Enjoy your class.
Okay, so we were discussing the arbitrage, right? And we said arbitrage will exist when we compare the futures price and the theoretical price, and we have a significant figures. So we have the theoretical futures price, right? And we explain the theoretical price as the estimated or calculated value of an asset, security, or derivative based on the pricing model, based on the right pricing model rather than the current market price of any of those assets. So this is the formula for the theoretical price. We have it here. I've explained what each and everything here is. This is the spot price. This is your Euler's number, right? Last week I gave it. I was supposed to update it here before sharing again. I forgot. I think it's 2.71828, something like that. Let me quickly get it. Euler's number. 2.71828. Yes, this is it. So you need to cram this number or just have it at the back of your mind. Let me save it somewhere here. Save it here. So this is our Euler's number, right? So back to what we were doing. Then we have this small symbol here is our dividend. Our arrow is our risk-free rate, and the time T here is the number of period we are looking at, right? So S&P 500 futures on December 16, 2012, we apply the formula using the market data. Okay, so we look at this example here. I think this is the example I was trying to look at last week when network took me out and I just couldn't join anymore. So guys, we'll meet this Wednesday, okay? Unfailingly, because time is not on our side again. I don't know why network keeps messing me up. So we have given the spot S&P 500 index. So you have your spot price of 1242.87. You have your dividend yield of 1.89%. You have your futures price given as this for March 2011 and June 2011. You have 1238.50 and 1233.60 respectively. You have interest rates for treasury bills and your LIBOR. We already explained what LIBOR is, right? You know your treasury bills rate, which is more like your risk-free rate. 0.3 months is 3 months rather is 0.25 years, right? 6 months is half a year, so it's 0.5 years. That is it. So I asked you guys to work on this. So how many of you did? If you did, let's just continue. If you understand this or you want me to work it out, speak up,
Sorry,
please. We don't have time. Much of
don't
our time
understand. Sorry.
taken.
Please work it out.
What if you don't understand?
You guys were supposed to work on this, so okay, no problem. So we have this, we apply the formula, right? So our theoretical price here is, so who will tell me what our spot rate is? This is our spot rate, right? 1248. Let me take it to my Excel. So you have your spot rate, right? Is this right? Sorry, I'm just used to using this other browser. So this is your spot rate. Then you come here. Then you have your what next? The Euler's number, right? So come here, we'll take this and put it here, call it our E, right? So we have E, right? Next thing we are looking at is what? We have our dividend yield, So I'll call this DY, right? 1.89%. Then what next? We have our time. So I will do this one example or maybe two examples. 0.25. So we can come here and say T. This is T, right? T. Then we also need our risk-free rate, right? Or just your interest rates. Because it's treasury bills, so we want to see whether there's an arbitrage on treasury bills. So we'll bring this and we'll call it R. R, right? So our formula, the formula is saying that your spot rate minus this, right? So this is 1.8 1.889. So you first of all do this, your risk-free rate minus your dividend yield, right? And this will give you minus 1.7%. Then you raise it to the power of your time, right? Raise to power your time, this. Oops, sorry. So I'm guessing I need to I'm guessing I'm coming. I need to make this a number. 1.76, right? Divided by 100. So we should have this. Why is this still giving me percentage? I have something like this. It's supposed to. Why am I having an error here? So Oh, sorry. This minus this, right? So this times this. I was applying the wrong thing there. This times this, right? So this is what we will have. So this, you now said this value that we have here. So this value that I have here, this value that I have here, that is the fonts are highlighted on red, represents this part of the equation. Do we agree? Do we agree? Nobody is speaking. No, say
No,
something.
no,
Sir,
no.
please take it
Do we
again, sir.
agree?
Please
No.
translate.
You do not agree. Why do you not? It's
Sir,
not
can
clear.
you? It's
Okay,
not clear.
Sir, please,
let me
it's
see.
not clear. I don't really understand.
Okay. So I'm screenshotting this.
Which question are we solving, please?
Okay.
Where is the question? Is it from the study pack?
Just a small example, right? This is just a small example. This is what we are solving here. You have been given all this information. This is the solution here in this small table here, and then this is the analysis, right? What are we trying to achieve? We want to see whether an arbitrage opportunity exists in this market, the market where we have this information, right? How do we see if the arbitrage exists? We check the theoretical price against the future and the forward the futures price, right? If the difference is significant, then we will know that in this instrument that is here, there is an opportunity for arbitrage trading. You understand? That's what it's simply saying. So in this S&P 500 future index, there is an opportunity for arbitrage trading. So how do you know that that opportunity exists? They say arbitrage involves taking advantage of price differences between two or more markets to make a risk-free profit. Okay, in index arbitrage, that is index arbitrage, right? Traders compare the futures price of an index with its theoretical price. This is the formula for the theoretical price. Then they've given you the futures price for March and June. So now, given the information that is available here, we want to determine the theoretical price. Have we followed up to this point? What I've just explained. This is the same thing. I was able to explain this last week, Wednesday, before network took me out. We've explained this. I just want to quickly work on one or two of these examples here, of this answer here. Explain it, then we move on. You get? So that's where we are. So I've copied the equation. I took a screenshot of the formula rather. I'm going to paste it on my Excel here so we can be looking at it and working on it together. Now, if you look at it, now this SO here is the same thing as this SO I've brought in from the equation, from the question that we had dealing with. They told you that giving your spot S&P 500 index price as 1242.87. Are we fine with this? Your dividend yield is 1.89 and your futures price for two periods, March and June, right? Two periods, March and June. You have 1238.5 for March, 1233.5. Now you are giving interest rates for treasury bills. These interest rates for treasury bills, they are more like the risk-free rates, right? And you're also giving your interbank lending rate. This is your LIBOR. They gave you LIBOR, they gave you your treasury bill rate. Now, with this information, you are meant to do what? Determine your theoretical price, compare it to this futures price, and tell if there is a significant difference, you can now say that, okay, that we have an opportunity for arbitrage in this market. Are we together?
Yes, sir.
Yes,
Are
sir.
we together? Please
Yes,
respond.
sir. Yes, sir.
Yes, sir. We are following, sir.
Okay, so we have our spot rate here. Our spot rate is 1242. We have the Euler's number, which is 2.712828. We have your dividend yield, which is 1.89%. You have your time. In 3 months, we know is a quarter of a year, right? So it's 0.25. Your rate, interest rate. But in this first one that we are testing the treasury bill. So it's more like the risk-free rate. So we have the rate of 0.13 for this first one. So this is the first one I'm testing, right? This is the first one. So what do we do? Bring it into this formula here. So if we are bringing it into this formula, we already know what our spot rate is. So we need to work with this side, this other side, the right hand side, if I'm correct. The right hand side. So you have your Euler's number raised to power your risk-free rate minus your dividend yield, close bracket, times the time, right? So we work on this bracket first. So if you work on this bracket, you have this value here minus this value. Do you agree? 0.13% minus 1.89%. If you do that, you have 1.76%. However, that was what I did, but I just divided it by 100 so that we have the actual value, right? I don't want it to be in percentage. So this is this minus this. Those guys on YouTube, they usually complain that they don't see my screen enough. So I'm going to zoom this out for their sake. So if we do that, please mute. If you don't want a question, please mute. I don't have time. I will take you out. You are the one. You are the one making noise. Please mute. Let me see the person's name. So I will tell my good friend.
Not the
I will tell my
one.
good
This is
friend
your
to
mommy.
take you out.
Amy. I will run
Mute. You
What
have
is
2
happening
minutes.
now? Chinenye, please.
I don't know what's wrong with my listener.
Chinenye, you are the one who. You are the one. You are saying you are not. You are the one. Because of that
This is
cute voice in your
your
background, I don't want to. Oh, okay, Kabiru, please, if you are still with us, can you help me take Chinenye out?
Alfred
Okay.
Obama. Okay, that's our teacher, Abi.
She's out. Yes, it's me. Yes, I'm the one.
Okay.
Don't shout
Sorry.
at me, oh, madam.
I just want to know the person
Don't
that is
worry.
disturbing us. Thank you.
No, I'm the one. You want to chase me too? It's all right. Okay, let's continue. So so this is what we have, right? So this is how I arrived at this 0 point. Just divide this by 100, right? So I'm taking this out. So we have this value. Now, if you know the formula says that, let me drag this closer. You know the formula says R minus your dividend yield times 0.3 and times 0.25. Your T is 0.25, right? That's 3 months, right? So if you do that, you have 0.044440, right? So this is what we have. So we are done with this part of the formula, right? So the next thing we need to do is bring in our Euler's number, which is this, and raise it to the power of whatever solution we have here. So if we raise it to this, we have this value. So if you now do, so we are done with the right hand side of the formula, right? So the left hand side is just our spot rate, right? That is after the side between the x, which is multiplication here, right? Usually I could have put full stop, but I decided to put x so that it will be very clear for everybody to see. So the right hand side of the x after x is 0.99. The left hand side is our spot rate, right? The left hand side is our spot rate, which is equal to this times this value, right? So if we do that, we will now have 1237.413. So let's see what we have in the solution. So if we come back to our notes, we have 1237.41, right? So we did not bring in the other value, just to 2 decimal, right? So 0.41. So this is what we have here. So if you apply this same step, on this table, you see theoretical price for T-bill. So for this and this, these are their theoretical prices, right? 1237 and 1232. So if you apply the same step for these 6 months, you will get this, right? If you apply the same step for LIBOR, theoretical price for LIBOR, you will have 1237.94 for 3 months LIBOR. Theoretical price for 6 months LIBOR, that's 0.5 years, you have 1234.02. Are we together? Is there anything
Yes,
that you
sir.
do not understand? I've just worked one out. I worked this one out. And I'm telling you that if you follow the same step and apply it for each of these other ones, these remaining 3, you will arrive at this answer, this answer, this answer. Right? Is there anybody that does not understand what I'm saying?
Sir.
Yes,
Sir,
sir.
yes,
Yes,
sir.
sir.
You understand, right?
Yes, sir.
Yes, sir.
Okay. Okay. That's perfect. So what you now need to do after arriving at this is to now compare it to this price, right? So for this one, March 2023, right, is 3 months, right? So you know that from January to March is 3 months, right? So it means that the 3 months treasury bill and the 3 months LIBOR will be applied to this value. Do you get my point? That's the first one, the first quarter of the year, Q1. The first quarter of the year, Q1, you have 1238.5, and you compare it to this. That's why we have March for this. This is the 3 months period, right? So for the 6 months period, which is this one and this one, they will now be compared to June 2020 and 2011. Do you get that point? So that is how you will compare it. So if you look at this one, you have 1238.5. If you compare it to this, by comparison will mean that you deduct it and see if there is a significant difference. So we can see that the difference is just about 1, right? Which is not much. The difference is just about 1. So by this value of 1, it means that there is very little or no opportunity for arbitrage. So even if you try to go into an arbitrage trade, you might not make as much profit as you expect. You might not make very good profit, right? So even if you do for this other one too, you will still arrive at the same answer, similar answers, maybe some just slightly above what we already have or slightly less, but they are just very, very minute differences that you have, right? So let's look at the analysis. Say for March 2020, 11, both theoretical price using treasury bill and LIBOR are slightly lower than the actual price. They are slightly lower. So if you look at this is 1237.41, 1237.94. They are just slightly lower than this, right? So for June, the actual price lies between the theoretical price calculated using treasury bill and LIBOR. So the basic explanation here is that the differences between the actual and theoretical price is very small, about 0.4%, indicating no strong arbitrage opportunity. That is what you need to understand about what we are looking here. So arbitrage in practice. So these are some of the things you might face. How to compare the arbitrage prices when you are looking at futures, index futures, right? So we continue. But is there anybody that does not understand anything here? Everything we've explained. This is coming from last Wednesday. I think we've already taken enough time. I don't know how I can rush through this. Any question?
Yes,
Okay, I assume no question. So I'll just continue.
I,
Hello?
I'm raising my hand. I have a question.
Somebody is raising their hand. My battery is very low.
Yes, sir.
Okay, let me hear your question. Let me hear your question.
Okay, I want to ask at what percentage, what is the figure before you say that there's a significant difference? Like this one we did now, just 1 point, which is insignificant. So at what point would we say is significant?
Okay, so that's a good question. However, it's mainly down to what word will I use now? It's mainly down to your personal judgment. Let me put it that way. You understand? Let me use the word your personal judgment. So there is no particular benchmark, say 10% or 5% or this thing, because at every point where there is a difference, they indicate an opportunity for a profit. When there is a difference, they indicate an opportunity for a profit. However, the level of difference will determine if you have a very good profit. You understand? Even this one that we are seeing here, even this one that we are seeing can still get you something, but it will not be something that will be good enough if you are having a difference of 5 or 10. The absolute situation of no profit at all will be when you have this as 0. If you have it at negative self, it might even be that there is no opportunity to, but the absolute will be when it is 0. You get the point. So it is relative based on your investment objective. And don't forget, the more money you invest, the higher you get. So for somebody that have $1,000 to invest, this might not get him anything. He might, at the end of the day, he might just get $2 or $1 profit. But somebody that have like 100 billion, it might just okay, even if it's the slightest opportunity, if he invests his $100 billion, he can still make up to $2,000 or $3,000. So these things are relative. You get. So on this particular one, there is no benchmark for you to just say, okay, this is absolute figure that I should be targeting. That okay, when I have a difference of 5%, it just tells you the level of profitability that might exist in that situation. Do you get me?
Yes, sir. Thank you very much.
Okay, who's next? Somebody raised their hand again. Osap Dolov is something. Okay, your hand is down. No much time
Yes,
to waste, so I'll just move ahead. Are you talking? Your mic is off. Please, my mic is off.
I said I was the one that just asked question just now.
Like,
I'm clear with the
hey,
explanation.
please mute. Felix, mute. Felix, mute. Kabiru, are you still with me? Kabiru. Ouch, I got left. Felix, please, you guys, I believe we're all adults. Please, I beg you. I beg you. If you don't have a question, mute. Please. I'm in the mood to take people out. Just that I'm not the one that set this meeting up. If not, I would have taken some persons out. Please, let's just try to comport ourselves. Thank you. So choosing the right interest that you want to go, maybe you want to use the treasury bill or the LIBOR, it depends. With treasury bill, we have the liquidity premium, right? Because treasury bill has very low risk, so there is a liquidity premium. It means that it is easy to sell treasury bills, right? So there is a lot of money in treasury bills. So you can easily sell it and all those kind of things and buy it. So there is money there. However, with other assets where LIBOR comes in, they have less liquidity, and there is an opportunity for default risk, right, to occur. So these ones um these ones attract more risk. So we know that the rate that attracts more risk will also attract more reward, right? So you do all these analysis and decide which of the ones you are willing to take use as a measure for your investment or arbitrage opportunity. The ideal interest risk to use in the future lies between Treasury and LIBOR, T-bills and LIBOR. This reflects the nature of futures contracts which are collateralized daily and considered low risk, but not entirely risk-free. There is no investment that is entirely risk-free, even though we have government investment that will tell you that, okay, the government will always pay. There might still be opportunities for risk. Risk can also come in the form of defaults. Not that it will not eventually be paid, but maybe when you are expecting your interest, you will not get it. That's also a form of risk, right? So that is it with this. So we move with uses of index future. An index futures contract. So this is, we are going into futures contracts properly. Now I brought this particularly cross hedging and asset allocation. I brought them in particularly for the sake of bringing them in. I do not expect this to be asked in your exam. That doesn't mean you will not read it, because there's a lot to it. There's a lot to it, cross edging and asset allocation. But I want you to have the ideas, because the things that we'll be doing going forward, they are built on it, right? They are built on it. Okay. So an index future contract is an agreement to buy or sell a stock. We already know what futures are, at a future date for a predetermined price. Although it's possible to synthesize an index using forwards or individual stocks, traders and investors prefer to use futures because they allow low cost exposure to market index. They are cheaper to trade than buying or selling each stock in the index individually. They are ideal for temporary investments or hedges. So when they talk about index futures, let's look at it. This is made up of two terms, right? Index, and we also have the futures. I've explained what indexes are, right? So can somebody just briefly tell me what index are, or what an index is? Yes, somebody. We explained what index are in this class. I'm very, very sure of it. Please, we don't have time. Anybody, come in, guys. Anybody? I can't believe this. Nobody. Okay, my system is running low. Permit me to get charger. Just hold on a minute. Okay, guys, I'm back.
Welcome back, sir.
Okay, um, good to be back as well. So let's continue. So I was asking what is an index? I believe I've touched this in this class. I just want a brief explanation, right? And nobody is giving me an answer. I can not ask you what is an index, so but you know why understanding all these concepts? That's how I study. I don't When I study, I don't leave any stone unturned, right? I know there are some of us that are more interested in pressing calculators, but the literature to everything is very important. Those small words, there are things that could throw you off balance in exam. You understand? You might just have a general idea, but these little things, if you don't have a good understanding or grasp of them, you might be surprised by the amount of information or understanding that is attached to these little terms that you are taking for granted. You understand? So if you don't understand them, when you are reading a question, you might not even know what that question is talking about. So it is important to know things in the tiny bits as much as possible. The little details, they matter. You understand? Different things work for different people, but I'm just telling you what works for me. So don't leave anything. Don't just take it that this one is not important or something. So this term index, I've explained that is a collection of assets, right? Is a measure of a collection of assets. And we use the S&P 500. In most textbooks, they will be using this S&P 500 index. What does this S&P 500? They are the top five, the stocks of the top five US companies, the stocks of the top 500 US companies. This index measure their performance. So when you are trading the S&P 500 index, you are trading the stocks of 500 companies, the top 500 companies in the US, based on an average price. The total, their individual stock prices, then they do like an average. There's a computation to it, so that's what determines the movement of this S&P 500 index. So that's what an index is. It's a collection of stocks, right? There are different types of indexes, but this is the most popular one that is used commonly in textbooks. So when you say an index futures, you are not just talking about the futures of one stock or one asset. You are looking at the futures of a collection of assets that is measured by one indices or one index. You get? Am I making sense?
Yes, sir.
This is the second time I'm explaining. Okay, no problem. So let's continue. An index futures contract. So at least you have the idea of what we are talking when we say index futures. Index futures contract is an agreement to buy or sell a stock market index, right? Like the S&P 500 at a future date for a predetermined price, just like the forward contract. You agree the price in the future. Although it's possible to synthesize an index using forward or individual stocks, traders and investors prefer index futures because what? They allow low cost exposure to market index. So using index futures, you are not exposed to. Imagine if you have to go and buy individual stocks for these 500 companies. You know your exposure to either the upside or low side is large, right? But when you are using this index, you are just it reduces that exposure, right? So there is a low cost exposure. So also in terms of um your margins, we've talked about margins and all that, right? For your futures account, you don't have to have too many margins for too many stocks. You just have one stock, sorry, one index, a margin account, and all those kind of things. So your exposure is reduced. They are cheaper to trade than buying or selling each stock in the index individually. I've already explained that while I was explaining this. They are ideal for temporary investments or hedges. So if you want to hedge temporarily, we are going to look at different hedging techniques when you are when we talk about the index futures. That's why part of the reason why I brought in asset allocation. So two main uses of index futures. We have asset allocation and cross hedging a related portfolio. We are going to look at these two in details, but let me just give a brief explanation. So when you look at asset allocation, it's a way of investing in different assets without actually owning all the assets, right? It's a way of investing in different assets without actually owning all the assets. So it means that you are able to shift your investments between different types of assets, right? Instead of directly trading individual securities. So the asset allocation, let me just read it through so that I will get a better way to explain it. Asset allocation means shifting investment between different asset types like stocks, bonds, money market instruments instead of directly trading securities, which can be expensive. Investors can use forward contracts or futures to create a synthetic asset. So we know what synthetic contracts are, right? We've already explained synthetic contracts. So you can use futures to create a synthetic position that enables you um to trade in other assets while holding a position. In case something happen in the other asset, one position is able to help you stabilize. So you can use the return from here to clear out the loss from here and all those kind of things, right? So you can use futures and forward contracts to do that. This allows managers to invest in the stock index without owning actual stocks. In addition, get exposure to commodities without holding them physically. So basically what they are saying with the asset allocation, it enables you to move from one position of investment to another. You are able to move from one position of investment to another, but you are not trading all of them together. So you do this with the futures or the forward contract. Let's look at this example. It will help us get a better picture of what this asset allocation is. So switching from stocks to treasury bills. Suppose you are invested in the S&P 500 index, but now you want to temporarily switch to treasury bills. You have the S&P 500 index, but you want to temporarily switch to treasury bills. Instead of selling all your 500 stocks, right, in the S&P 500, what will you do? You keep the stock portfolio, take a short position in the S&P 500 forward contract. This strategy is known as cash and carry and acts like a synthetic treasury bill. Later, when you want to go back to your stocks, just offset or close the forward position. There is an example here that will explain this further, but let me see if I can give you an idea of what they are saying before we move forward. So it says that instead of selling all your stocks, you keep your portfolio, you take a short position in the S&P 500 forward contract, right? So now, what do you do with your treasury bill? Your treasury bill your guarantees you a particular return at a particular time, right? However, with your stocks, that is your index, you are not guaranteed a return. Am I making sense? Somebody respond. With a treasury bill, you are guaranteed a return, right? So if you buy the government treasury bill, they promise you an interest rate that is going to be
Yes, sir.
is for 90 days or whatever amount of days, 360 or 170 days, whatever that treasury bill. You are guaranteed 15% or whatever. But with your stock, you are not guaranteed any return, right? So now let's take that and keep it one side, right? Now, using your stock, you want to guarantee yourself a return of a particular percentage. You want to guarantee yourself a return of a particular percentage. So, if you want to guarantee yourself a return of a particular percentage, that means you are trying to synthesize a treasury bill. Am I making sense? What do I mean by you are trying to synthesize a bill? You are trying to make that stock look like a treasury bill, because you can position yourself using the future or forward contract in such a way that in 6 months or whatever that treasury bill rate is, the forward or the futures contract can give you a return that is similar to that treasury bill. So somebody who is holding a treasury bill is not better than you who is holding the stock. Am I making sense?
Yes, sir.
You guys cannot hear me.
Can hear you, sir. Can hear
Okay.
you.
Okay, great.
Yes, sir.
So when if you are able to achieve that using your forward or futures, that is more like a synthetic contract, right? It's a synthetic contract because you are using it to mimic the exposure. Let me use that word, mimic. You are using it to impersonate. I don't know the particular word I can use now, but you are trying to make that project that asset give you a similar return like that of a treasury bill. So it is a synthetic contract in that form, right? So when you are able to achieve that, then you are saying you are doing what we call asset allocation. You get. So let's look at this example and I will explain it. Let's say example breakdown. Example breakdown. Assume the current index price, right? So the market index price, which is the spot rate or the spot price, is 100. You have the 1 year risk-free rate, which is 10%. That is like your treasury bill rate, right? So your 1 year forward price, is 110. So now you agree a forward price. You know, all of us know how the forward contract was, right? You agree today what you buy or sell the stock in the future. You agree today. So you are agreeing today what the future price will be. So with the forward contract, you are saying in 1 year, we are going to buy or we are going to sell this index for 110. The current price, the price today right now is $100. Possible index prices in 1 year could be 80 or 130, right? Let me highlight this part. So this is one part. Now they are not saying that, for example, in the future, it is possible that the index price could be $80 or 130. We know that in reality it can be even lower than this, higher than this, or somewhere in between. It can be any value. But for the purpose of this example, they are saying it could be 80 or 130. Now let's look at, if you sell the stocks and buy treasury bills today, you will get 110 after 1 year. So what they are trying to tell you that the treasury bill, if you buy treasury bill today, you are going to get 110, because they have already mentioned here that the risk-free rate is 10%, right? So the treasury bill price today, what they are trying to tell us, that the treasury bill price today, if we sell this stock today, that's what they are saying. If you sell the stock and buy treasury bill, that means you sell the stock for 100, which is the spot price, and you use that 100 naira to go and buy treasury bill, because the risk-free rate is 10%. So in the future, which is that 1 year time, you will get 100 and you will get 110. That means 100 plus your 10%. Are we following? Are you guys following me in how I'm breaking this thing down now?
Yes, yes.
You are following.
We're following.
Yes. So far, I've not confused anybody. I have succeeded in explaining all this because we'll come down to this table now. But what happens if you keep the stock and short the forward contract? So this is just an idea. What they stated here is just an idea. This is not what you do or what you are going to do. It's just an idea. They are just saying that, okay, assuming we don't want to hold this stock again, we want a more safe investment. We decide to sell for 100 naira. Now we are going to get 110 in the future, right? But because of these possibilities here, we still want to hold our stock. We don't want to sell. But this could be the possible values we get in the future. This could be the possible values we get in the future, right? 80 or 130, right? So now we want to trade in such a way that we can be able to mimic the return on this treasury bill, right? So they say if you don't sell, so you still keep your stock, you are still holding at this spot rate. If you keep the stock and short the forward contract. Now, in a forward contract, if you are shorting the forward contract, you will gain if the price of the asset drops, right? And you will lose if the price of the asset increases, right? This is the forward contract, right? So here's the result. If you own the stock, today you own the stock, so you buy the stock today at 110 naira, 100 naira. If in 1 year the stock price drops to 80, right? This means that you would have lost 20. And if in 1 year the stock price increases to 130, it means that you would have done what? You would have gained 30. Now, let's look at it from this position. Don't forget what they said here is that your spot rate for 1 year, your forward price for 1 year is 110, right? So now, I've left this first row here. I've left this first row. I am coming to the second row. So now the second row says that you short at 110. You short at 110. If you short at 110 and the price drops to 80, if the price drops to 80, don't forget this is your forward contract. You short it at 110. The price now drops to 80. What happens to you? Somebody should tell me.
You will gain 30 naira.
Good. You will gain 30 naira. Do we all understand this logic? Or somebody is confused why you will gain 30 naira if you have already agreed that you will pay 110 in the future? Is somebody confused about this? Nobody is responding, so I think it's you are
Yes,
all
yes,
fine.
yes.
If
I'm
the price,
confused. I'm confused. Please explain, please.
I'm confused, please.
I'm confused, please.
okay,
Say if you shot at
okay.
110.
Have you been following?
Yes.
Yes. Have you been, sorry, let me go online. Let me go back to the class. Who is speaking, please? Did you tell it?
Yes. You said if you shot at
Okay.
110,
Sorry.
you lose. Hello?
Okay. Have you been following this our class? Yeah? This is not
Yes,
your
yes,
first time, right?
yes.
It's not your first time. Okay. That's just what I want to establish because I don't
Okay.
want to go back too far. Okay.
Okay.
So now you have you have um you have your index, right? The spot price of that index is 100. Now you know that a futures contract. You have a futures forward contract. Now, I've explained this that when you short, you gain when the price falls. In the normal stock market, when you short, you gain when the price falls. So, your futures contract, you have a short position. That means you are agreeing that since I have a short position in this forward contract, as at so point in time, right? There's the time here we are looking at is 1 year. If you get to 1 year, you ought to sell this contract. That is what it means. You ought to sell this contract. So somebody is buying this contract from you. So when they say you short, it means you are the one selling. So somebody is buying the contract from you, right? So if you have already agreed that you are going to sell for 110, that means somebody is paying you 110. So you are receiving 110, and the asset that you are selling for 110, the price is now 80. Do you get the point, Felix? The asset you are selling for 110 after that 1 year time,
Yes,
the
please.
price of that asset is now
Yes.
80. So do you understand how you get profit?
Yes, now I understand now.
Do you
Please, you can
understand?
go on. Yes, please.
So you make profit because selling way above what the market price is. You get the same thing applies to this other position. The same thing applies to this other one. If you agree to short and the market increase, it means that you are selling below the market price. So you are losing 20, right? So you are losing 20. Now, if 80 that is the market price as at that 1 year, right? Plus the $30 that you gain when the price fell, you will have gained 110 naira, $110. If you look at this other position, yeah, when the price increased to 130, right? When the price increased to 130, when you short the forward, you lost 20. So 130 minus 20, you still got 110. This 110 is the same return. That means your actual return is just 10 naira. Either way, whether the market goes down to 80 or increases to 130, the actual return is just 10, assuming you are still holding this asset. Assume you are still holding this asset at you are still holding this index, right? You are still holding this index. You did not sell it, but you use a forward contract to mimic or to position yourself in such a way that you will gain based on what the risk-free rate is at a particular time. Please tell me, have I succeeded in enlightening you about this or confusing you? How you are able to use a forward contract to or synthesize with your forward contract to give you the return on a treasury bill. I think my time to explain each part
Your
of this
voice is
question.
not
Yes?
clear. I don't know whether it's just from my end.
Okay, let me read what we have here. Therefore, no matter what happens to the stock value, the total return is 110. That is 10% return. Same as treasury bills. This works because the forward contract locks in a price, giving a risk-free return if there is no arbitrage. I took my time to break this explanation down of asset allocation. The whole idea,
the whole idea is here is to hold a particular. This is still a form of hedging. These are different ways. All we've been doing is learning how to use all these. We've done options, forwards. Now we are into futures. This is an index futures, right? And we know that and forwards, they are not too different. It's just we have one or two differences which we've already explained. Now, what we are doing with asset allocation is still a form of hedging. However, in this form of hedging, we are not looking at. I know from previous ones we have taught you guys is that when you hedge in such a way that when you make return on this one, you will not use it to go and clear the loss that you are getting from the other one. This is not how this asset allocation works. Asset allocation is going to work in such a way that you are using one asset to mimic the return that will be gotten from another asset. So that even if that asset that you are holding, no matter what happens, you are going to get return based on how another asset is going to move. And best asset, the asset that people make is the treasury bills, because that one gives a guaranteed return, even though we know that there is no guaranteed return entirely. You understand? But we all know that what the risk really is. So people can still hold. I'm trying to explain the rationale now behind asset allocation. People can still hold stocks, and because of the level of uncertainty you hold in holding stocks, you want to position yourself in such a way that whether I gain or lose, my gain or loss will still, no, sorry, not loss, my gain will still, bad as bad, it will still reflect the loss, sorry, the gain that somebody who is holding a treasury bill is getting. You get. So you want to make that return on the treasury bill. That doesn't mean you can't use asset allocation for other to make return on other assets, but treasury bill is the one that is mostly used, right? So that is everything that I've tried to explain here. With this example, they say you have an asset, right? You are holding an index you are holding an index, and the spot rate, which is the current market rate, is 110. They say risk-free rate, which is like the return on treasury bills, is 10%, right? 1 year forward price. Now, this is what you are now going to do. You are now going into a forward price, and you are now agreeing that these assets that I am holding, in 1 year, I should be able to sell it for 110. So you and Mr. A and Mr. B agree. Mr. A is the one selling. He's the one that owns the contract, right? So he owns the asset. So he enters into a contract and say, in 1 year, I should be able to sell it for 110. Now, you know this 110, this extra 10 here, let me highlight it. It's 10% on this $100, which is the same thing as the return on your risk-free rate. Do you agree that one with me first?
Yes, sir.
Yes, sir.
Do you agree that one? Of you that say that you do not understand. Okay. It's the same thing as the return on your risk-free rate. Good. That's fine. Now they're now telling you that if you are holding these assets, now this part that I have explained, take it and keep it in one side of your mind. Now they are now saying that if you are holding these assets, if you are holding these assets, two things could happen. Initially, when I explained, I said many things could happen, but for the purpose of this example, they are saying two things could happen. It's either the price goes to 80, or it falls to 80, or it increases to 130, right? So now, don't forget what your objective is. You are not holding a treasury bill, but you want to earn the same return that somebody that is holding a treasury bill will earn. That is your objective, right? If you sell the stocks and buy treasury bills, you will get 110. So you have now gone to do an analysis and say that, okay, assuming I sell this my stock and buy treasury bill, this is the same return I will get. So I don't want to sell this stock, but I want to make sure that in 1 year time, I will get this exact return. Because with treasury bill, you know your rates. You are guaranteed your return. You know how you can calculate how much you are going to earn, whether you are buying the 90-day treasury bill, 360-day bill, whatever the case may be. You know what you are going to. Okay, let me tell you one of my experiences, right? For the purpose of this class, when I was writing SFM, I didn't attend the tuition center that we had too many people. I think it was just very few of us. So in one of these classes, it was just me and this lecturer. We were just starting the classes, and the guy is not good. So from the first class, I already told myself that me and this guy go fight one day. Sooner or later, we'll go tear each other eye, because I just know that he cannot teach me. It's not about pride or anything. I just know that he cannot teach me. So in one of the classes, he just mentioned something that you cannot be writing SFM and you don't have a stock. That I am my stock. So I found out these things. In my mind, I was like, okay, let me see, first of all, be able to feed myself. Make I see food shop first. Why do I need to go and buy stock because I'm writing like am? So that is what he said. And that's just, at the end of the day, I reported him. He left the class. The tuition center told him to go. Somebody else came up, and that person that came is part of the reason why you have Apex as it is today, right? It's a long story, but that's just the whole thing there. So why am I telling you this? That thing just stuck to me, and after then I've been trading. You understand? I've been trading. I trade assets. I have buy stocks from time to time, make some good profits and losses there, here and there. Why am I explaining all this to you? I'm not telling you like that guy told me that you should go and buy stocks, but I'm just saying that if you can, it's very good for you to get into these things. And the beautiful thing is that in this our generation, we have the opportunity where you can put little money. You don't need to put too much money. You understand? I'm just saying it for those that do not really have money. But I'm just trying to pick your interest in it. Do these things so that it will give you more idea. And believe me, investment, you can never go wrong with investing. Okay? I'm not saying you should go and do Rob Peter Pay Paul MMM investment. Oh, no, I'm not telling you to do MMM, but as much as you can, if it's treasury bills, buy. I know the kind of country that we are, most of us have even given up. So you can look at ways you can buy. You can buy US stocks. You can buy this thing, stocks of Chinese companies and all. They will give you a good idea of investments, and if you are able to dig in deep, you will make good money, you will make profit, and if God blesses you, you can make a whole lot of money. But that doesn't mean that you will not incur losses as well. Okay, it's part of the market. And if you are not willing to, just know your risk profile, know what you are able of, what you are capable of accepting or losing, and invest some as little as 5,000 naira. I'm telling you the truth. As little as 5,000, you can buy stocks and all those kind of things. So why am I telling you this? It's because it will give you better idea, practical knowledge. For those of us that are in investment banking, we already have the practical knowledge. For those that are not, for your individual selves, you can do that. Okay, it will give you practical knowledge. So just try. There are many apps like Bamboo, many. Please don't invest in something you don't know about. Always do your research properly. So it brings me back to what we are saying. If you sell the stocks and buy treasury bills, you will get $110 after 1 year. But what happens if you keep the stock and short the forward contract? Here's the result. So now they gave us two possible outcomes, right? $80 and $130. They now say what you should do was short your market at 110. So you have already locked in your price at 110. So this simply means that leave all this brouhaha here. Leave all this brouhaha here. All these plenty things. Let's keep it one side. Let me copy this table to Excel. Oops, it did not copy, it did not paste the way I want it to. Okay, so we'll just go back. So they leave all these plenty things here. Why I'm telling you to leave all this, I'm not saying it's not important, but this part where you just short and lock your market here at this price is already, the idea is that this 110 already is giving you the return that somebody that will earn treasury bill. You've already locked in the price with this 110. So you are going to earn the same return, 10%, that somebody that is going into treasury bill is going to earn, irrespective of how your market moves. That is the whole idea. But why is this part coming in now? This part is just telling you that if we assume that the price falls to 80, right? If the price falls to 80, why is this 110 important? You would have gained 30 naira, right? You would have gained 30 naira because you sold what is currently worth 80 for 110 naira. $10. Sorry, I'm used to our local currency. So you would have gained what is currently worth $80. You are selling it for 110. So you are gaining 30 naira, right? So if you add that 30 naira to the current market price as of that day, it brings you back to your 110, which is the normal logic, right? The same thing applies here. If the market price is 130, you sell at 110, you lose $20. Don't forget, this $20 is not like an actual loss that you are losing. It's the loss based on market price, right? So if you take out the 20 from your 30, you are still receiving 130. So irrespective of how the market goes, you have already used your forward contract to lock in the treasury bill return. Am I making sense?
Yes, sir.
Okay. Madam, sorry, what's the name? There was this lady that said she did not understand. Do you understand now? Okay, we don't have time. She probably left the class already. So they say therefore, no matter what happens to the stock value, the total return is 110%, same as the treasury bills. Is the 10% rather, same as the treasury. This was because the forward contract locks in a price, giving the risk-free return if there is no arbitrage. Right? So we are good. Cross-hedging. Excuse me, a minute. I need hedging. When we talk about cross-hedging, we are not looking at the correlation between what we are hedging, right? We are not looking at the correlation between what we are hedging. So let me explain why it is important to look at the correlation. I believe each and every one of us here understand the importance of correlation. And at one point or the other, especially for those of us that did finance or something, you would have done econometrics, so you know correlation, you know regression, all those kind of things. So you know when they say perfectly correlated, imperfect correlation, you know the values that they apply to all those kind of things, right? So when you look at the correlation, you're not looking at the relationship between a portfolio and another portfolio. Now, cross hedging looks at how we can use one portfolio or one asset to hedge the risk in another asset based on the correlation that exists between those assets. So the correlation there is now telling you the possibility of using the risk and return that is attached to one portfolio or one asset to hedge the risk and return that is attached to another asset. For instance, you are investing in real estate, and then you are also investing in agriculture, right? You know that it is easier for you to use a portfolio in your real estate business to hedge the risk in another real estate business somewhere else. For instance, maybe you want to say, okay, if the prices of houses is falling in Abuja, the prices of houses in Lagos should be increasing. So I can use the gain I make from Lagos to cancel out the loss I make in Abuja. It is easier to do that kind of analysis. But when you are now looking at two entirely different things, maybe agriculture and this, so you are now saying I will use the return from agriculture to clear out the how are you sure that agriculture will even give you the same, will give you return, will give you a good return enough to clear the, or is that the term I should use? No. How are you sure that agriculture will even move in the same direction as real estate at a particular period of time? Because we know that the exposure, the risk that the agriculture industry faces is quite different from the risk that the real estate industry will face. Now, I'm not looking at an economic-wide risk. You understand? Because government can make policies that will affect all industries. For instance, the fuel subsidy that was taken out, it affected everybody. Or some, for instance, COVID-19. You understand? It affected them. So we are looking at the risks that are particular. You understand? I want to bring the term systematic and non-systematic in this scenario now. So let's just leave that out, because I know a lot of you now, your mind would have gone there. So let's just leave that for now. So we are looking at the risks and returns that are peculiar to the agricultural industry and the risks that are returns. So those are the things that you measure. So things like erosion, what else? Give me one or two examples that you know that can affect the agriculture and real estate in this explanation we are using now. Erosion. What else can we think of? You think that is peculiar to the what's it called, the real estate industries? Anybody? Anybody?
Sir, your voice is not too clear. I don't know whether it's only me.
My voice is not clear. Can
It's
you hear me
cracking.
better now?
Okay, it's clear now.
Yes,
It's clear now.
exactly.
Okay, okay. So what I'm saying is, okay, I'm just going to continue, right, so that we don't take too much time. So what I'm saying is, you are using the risk, you are looking at the correlation between the portfolios that you have. So let me just read so we progress, right? Cross-hedging is a risk management strategy where you hedge a position in one asset using a derivative contract based on a different but correlated assets. So, but when we say but correlated, you know, we have perfect correlation, imperfect correlation, right? This is often done when a direct hedge, that is, futures contract on the same asset, is not available. So you use cross hedging when you cannot use a particular. That's what I was trying to explain when I was saying real estate and agriculture, right? So when you are not able to get the stock, maybe you need to use the stock of a real estate company to hedge the risk of another real estate stock that you are holding. You are not able to do that. You might now need to go and use the stock of an agricultural company or a company that is into agriculture to hedge the risk of a company that is into something, real estate. When you are doing that, that is cross hedging. This is already 11 o'clock and the class has reduced to 36. Most persons would have gone to bed. So man, things are plenty. Oh. Things are plenty. My plan was to finish everything this week. So I'll just explain cross hedging. Then on Friday, sorry, on Wednesday, we see if we can finish. Is that fine?
Yes, sir.
Yes, sir.
Yes, sir.
Okay.
Okay. It's not okay. So when they say the hedge of a similar stock is not available or not liquid enough, instead you hedge with a related asset that moves similarly in price based on historical correlation. Cross hedging with index futures. Now applying this to index futures, here's how it works. Suppose you manage a portfolio that consists of various stocks, but it does not match the S&P 500. The composition or weight differ. However, you want to hedge the risks of a general downturn. So you use the S&P 500 to do so. This is cross hedging. Let me explain what they are saying here. Now applying this to index futures. So, but first of all, before we go into index futures, do we have the idea of what cross hedging is? Based on everything I've explained.
Yes, sir.
Yes,
Can you
sir.
hear me
Yes,
back?
Yes,
sir.
sir.
Yes,
Yes.
sir.
Yeah.
You have the idea. So well, let's go into index futures. Now applying this to index futures, here's how it works. Suppose you manage a portfolio that consists of various stocks, but it does not match the S&P 500 index. It does not match the S&P 500 index. The composition or weights differ. However, you want to hedge the risk of a general market downturn. So you use the S&P 500 futures to do so. This is cross hedging because you are hedging a non-S&P 500 portfolio using the S&P 500 futures, which track a different asset. So what they are simply saying is, we know what the index is, right? We know what the S&P 500 index is, right? Is a question. Okay. So they say, suppose you manage a portfolio that consists of various stocks. So you have a portfolio that consists of various stocks, but those stocks does not match the S&P 500 index. That is, the composition or weight differ. You know what I told you about the S&P 500 different stock. So now let's say the stocks that you manage, they are stocks of companies that do not fall within this S&P 500 index. That is the easiest way to explain this. There are stocks of companies that do not fall within the S&P 500 difference, S&P 500 index. Because as a result of that, you understand, you want to hedge their risk. You now go and use the S&P 500 index. So however, you want to hedge the risk of a general market downturn, so you use the S&P 500. So this, if you do that, because those stocks are not S&P, they do not fall within that index class. They are not part of the S&P 500. When you do that, you are hedging a non-S&P 500 portfolio using the S&P 500 futures, which track a different asset class, right? So as a result of what you are doing,
That is what we call cross hedging. Example of cross hedging with perfect correlation. So now, when they say there is perfect correlation, so we are looking at a correlation of 1, right? We are looking at a correlation of 1 or close to, very close to 1. So let's look at this example. You hold a portfolio of tech stocks. You believe the market and your portfolio will decline. You want to temporarily reduce your exposure. Essentially, shift your position into a risk-free asset like treasury bills. You get? There are no futures directly on your exact portfolio, but your portfolio is highly correlated with the S&P 500, say 0.98 correlation. So you sell your S&P 500 futures. So now you are taking a short position, right? This is a cross hedge because the assets differ. However, because the correlation is high, it reduces most of the risk. If the S&P 500 futures drop, your short futures gain in value, which offset losses in your portfolio. This means that gains or losses in your portfolio are fully offset by opposite gains or losses in the futures. Therefore, you've effectively neutralized your market risk. So now let me explain this. So now you do the correlation between that your portfolio that you have and the S&P 500 futures and the S&P 500 index, and you see that they are perfectly correlated. So you can then assume that if, because there is a perfect correlation, if the S&P 500 index increases, your portfolio, the assets that you are holding in your portfolio is going to increase, right? And if the S&P 500 futures decreases, the what's it called? The assets that you are holding in your portfolio is going to reduce as well, right? So what do you do? Since there is a perfect correlation, so you know the movement, you are now expecting that the assets that you are holding in your portfolio, the stocks you are holding, they are going to drop. That is your expectation. So what do? You now go and buy that S&P 500 futures. Sorry, you will now go and short it. So you are holding that S&P 500 futures contract and you are shorting it. That means since the S&P 500 futures will drop, your portfolio will also drop. So because you are shorting the futures contract, it means that when the S&P 500 futures reduces, you are making a gain. When the S&P 500 futures contract drops, you are making a gain. And that gain will now be used to offset the losses you are going to get from the assets that you are holding. Am I making sense?
Yes, sir.
Yes.
Okay. So this is what you do when there is a perfect correlation. So you are cross hedging because number one, the S&P 500 futures you are holding is not the same as the S&P 500 futures that you short is not the same. Is not the same as the stocks you are holding, right? That means the two contracts are not related. But however, you have seen that there is a correlation in the movement of their market prices. So because of that correlation, you are now confident to go and short the S&P 500. You get? So if you do that, that is what we call cross hedging. Now, before I introduce asset allocation and this, I said I do not expect them to ask you this in the exam because I did a deep dive into your curriculum and I saw that they did not bring in asset correlation and cross hedging. I don't think they did. They brought it in. I checked properly. Maybe if you check later and see it, fine. It's for your own benefit. But I'm explaining it here because of the hedging technique or the hedging idea that lies in this for your own benefit, so that you can also apply it
anywhere you come across something that is related to this. So, however, in real life, back to what we are saying, in real life, chances of having a perfect correlation between assets is very, very slim, right? So in real life, what we have is what has higher chances is an imperfect correlation. So that's why you have the real world here, right? So in reality, most portfolios are not perfectly correlated with S&P 500 because your portfolio might have tech stocks or more mid-cap companies. So you know your this thing, your portfolio might just have different things, right? And all those different things do not really move in the same way as the S&P 500, right? Or more mid-cap companies, and the way your portfolio moves would always match the index. When this happens, the hedge using S&P 500 futures will help reduce risk, but it does not eliminate it. Now, in this future, in this other one that we looked at, we are looking at a case where you are able to hedge it completely, right? Because you are taking the gain from your S&P 500 and using it to eliminate the losses in the assets you are holding. But in this case, because of the imperfect nature, the S&P 500 will not be able to eliminate everything. It will not be able to eliminate the whole risk. However, it can only reduce it. So what do we mean? This other one, we are saying that the S&P 500 is moving in the same path. So if you are losing 500 naira in your normal portfolio, you are gaining 500 naira in your S&P 500 when you short it. In this case, you might be losing 10,000 and then you are gaining maybe 500 or 2,000 or this thing. You shall be left with some level of losses or something like that, whatever the case may be. That is just the difference between cross hedging, perfect correlation, and cross hedging, imperfect correlation. I will leave you to read the rest. Believe me when I say there is a lot of mathematics that comes into. So first of all, when you are giving these assets, you have to first of all compute their correlation, right? And that requires your correlation formula. Already we know that is a lot. Then you will now start doing your the probability of movements, all those kind of things. So I did not bring in all those computation in here because I don't want to, for the purpose of time and for the purpose of loading you with too many things that might not be necessary. I did not bring it. I only brought in the idea, right? So that's just it with cross hedging, with perfect correlation and imperfect correlation. So wherever you see this, you know what they are, you know what the results might be, whether it is a perfectly correlated portfolio or it is imperfect correlation. You know what you are expecting. So I've given you the basic idea. Read this up, and you'll be fine. Then on Wednesday, when we'll look at futures contracts. We'll look at futures contracts. We'll look at current. We'll look at covered interest arbitrage. These are all in your this thing. So now we are beginning to enter interest and exchange rates. Interest and exchange rates hedging, right? We're beginning to enter interest and exchange rate hedging, which is where your this thing is mainly focused, right? So, but the reason from the beginning of this class, I've been telling you that you need to understand all these contracts, how they work before we can go deep down into hedging with interest rate and exchange rates. If I had not taught you all these things and just jump into this, a lot of things will be confusing. But now I'm sure everybody who have been following this class from the beginning till date have a very, very good idea and understanding of different hedging techniques, different patterns. If you see questions, you'll be able, we'll solve a lot of questions, so many questions. I can question. If I have time, I will pick ACCA questions as well, just to build you up as much as possible, right?
But however, in here, I brought in questions as well. All these questions are very good questions. If you have enough time to read and finish this topic, I want you to attempt all these questions. I want you to attempt all these questions here, because if you can solve all these things, I don't see anything that is in ICANN that you cannot do. I swear down. I don't see anything that is in ICANN that you cannot do. All the questions we have been doing here, or you have good ideas of it. Somebody is laughing, but I'm telling you the truth. You have good ideas mainly scenario case study based, right? So they will tell you the manager of so. But at the end of the day, this is all what they are coming down to, right? How to hedge. They will not ask you, okay, what would the manager do? What does the manager expect? Well, this is the manager's suggestion. Is it correct? Is it not correct? So with all these techniques that you have, you should be able to apply it to that, and you are fine. Don't worry, when we start, you get all those things. You get it. Well, you just know all these things, how they work, each contract, the peculiarity of each contract, and we are good. Okay. So with that, I leave you with that. I wish you all a very good week. For my fellow football fans, like the Arsenal fans, try to sleep well this night. I know you people played good football today, but somehow did not get what they deserve. Try to sleep well. Um, Also, I wish you the best of luck this week.
Thank
Enjoy
you very much.
yourself. Don't enjoy too much.
Thank you, sir. Thank you very much, sir. We really
Thank you very much.
appreciate it.
God bless you.
Thank you,
We
sir.
appreciate
God
it.
bless
When
you.
I say
Thank you
enjoy
very
yourself,
much.
and
God bless you.
I'm not saying you should not enjoy you, but
Thank you.
don't enjoy and forget that you have exam when you're in school. Yeah? All right, God bless you. So,
God
see you
bless
on
you. God bless you. God bless you.
Good night.
take care of yourselves. Goodbye.
Thank you. Thank you. Thank you. Bye-bye.